What's up, everybody? It's Common Sense Investor coming at you with another video. I used to love James Bond before they put him in this woke generation. But today in this video, I thought that was fitting because I am going to unravel the mysteries of what implied volatility really is and how you can understand it very simple. Now, if you Googled it, you would get this following definition: that implied volatility is the market's forecast of the likely movement, usually one standard deviation, in the security's price. Now, that's saying a big mouthful there. And if you know how sentences are constructed, you have a subject, a verb, and so forth. And in this particular sentence, we got this adverbial phrase, usually one standard deviation. So what I'm going to do is I'm going to remove this from the definition, and we'll come back to what a standard deviation is in just a moment. But for now, we can remove that adverbial phrase, and now we have a sentence that says implied volatility is the market's forecast of the likely movement in the security's price, or in the options premium's price. All right? Now, again, that's still saying a mouthful. It would give you the impression that implied volatility is what the market believes your particular stock or option is going to do, go up or down, and that's not true. To find out what implied volatility really means, we got to go back to the etymology of the word. Yeah, somebody lives in a trailer park knows them words. But implied volatility simply means to imply or to express indirectly something. All right? Volatility, to change rapidly, and unpredictability. So now that if we put the two words together, implied volatility, it would mean to express indirectly a change rapidly and unpredictably in the price of the securities. Now, what this means is it's not going to give you a price movement directly of up or down by $2, by $1. It's not going to give you that. It's going to express it indirectly in the rapid change of the security's price. So if implied volatility's job is not to tell us whether the market is going to go up or the security is going to go down, what is its job? Well, its job is to give you a percentage of the price that it believes that the security will go up or down. Okay? You could also draw this out here, draw the little man thinking, draw your little charts here with your arrows, and then I want you to add on to it implied at the top and volatility at the bottom. All right? Because this is how it's going to be very, very simple for you to understand. The market believes that the stock option that you are looking at has a 40% volatility. And I'm going to reiterate this just to drive the point home so that you don't forget. The market's implied volatility forecast does not tell us that the stock is going to go up or that the stock will go down. What it tells us is the percentage that it believes the stock will move up or down. For example, at an IV of 40, then you need to understand that implied volatility is giving you this percentage to give you an idea of how high they believe this option strike price will go, premium will go, or how low. Draw it out just a little bit further and we see this. You take your implied volatility. What is it going to go up? What is it going to go down? It says that it's going to be 40%. So I plug in my 40% right there. All right. And another way to look at it is this right here. $10 stock or option, 40% IV. That's telling me that this $10 option can move up $14 or as low as $6. So then you may wonder, well, what good is this indicator if it's just going to give me the swing up and swing down, if it can't pinpoint exactly whether this is going to be a good investment or not? It gets better, people. But you have to understand first what implied volatility means. And that means that whatever percent that strike price is expected to move upwards that percent or downwards that percent. And it gives us this range to work with. And that's implied in volatility. Now, you got implied in volatility rank, implied in volatility percentile. There's a whole lot of other stuff that you're going to have to learn. But before we do, let me just go over here to Webull real quick and give you a real life example. Right here we see Apple is trading at $150.70. All right, and we're interested in the Apple call options. Call options are on the left, puts are on the right. And if we scroll right here, we can see that the implied volatility for the $150 strike price is 37.24%. 37.24%. And we plug those numbers into our chart here. We see that the strike price for the $150 call, the IV or implied volatility, is 37.24%. So what will the swing be up and down of Apple according to the market's data? Well, you get your calculator and you say I got a $150 call minus 37.50 equals 112.50. So that means Apple is projected to fall to $112. So that means with an IV of 37.24, we take the strike price of 150 and we minus the IV, and that gives us a low of 112.50. And we add 37.25 to the total price at the top. And at the top we have $150 for the strike price plus your implied volatility gives us 187.24. So we now know that the Apple 150 strike price at 37.24 IV tells me that Apple should swing over the course of a year from 187.24 to $112.50. Now, that still doesn't, that's got a big old gap. That's like a $75 gap. And there are ways to shrink these numbers down to where you can get a better understanding of whether this option will be for you or not for you. But the very first step you take in looking for an option is to look at the implied volatility, set it up like I do right here, write your strike price, write your IV, and then add your IV to the strike price, subtract your IV from the strike price, and you will get the swing that Apple should go in within a year. Now, to strengthen this strategy even more, we talk about historical volatility. It goes hand in hand with implied volatility, and that's what we're going to be talking about maybe next. It took me 3 days to get this one done because I just couldn't figure out how to explain it better. But it don't get no better than this. There's a 68% probability that Apple will move up to 187 or down to 112 within the next year, because IV is calculated according to the year. Also, you can calculate it to the day, the week, the month, or the year, which we'll get into that in a later video. But right now, just understand, implied volatility does not tell us whether the stock will go up or down. It tells us the swing in which it will go up and down as projected by the market. With that, love y'all. Be blessed. I got some more information. I had to get this out of here so I could be finished with this project and talk to y'all about the FTDs in APE. So that'll be coming up today. Love y'all. Be blessed. See you in the next video.
glitch in the matrix. They out here wildin' and it's too much, I can't take it. Red pill, blue pill, my mind knew they would shape it. Sound the alarm.